Hello, everyone, and thank you for joining us today for this Natixis CIB research webinar for clients and media. Alicia Garcia Herrero and Gary Ng will shortly be sharing their views on China's capital flows and bond markets. During the presentation, all participants will be on listen-only mode. We will have a Q&A session at the end of the presentation, during which time you will be able to unmute your microphone should you wish to ask a question. You may also share questions in the chat box or use the raise your hand function. And I would also like to let you know that today's session is being recorded. And with that, Gary and Alicia, over to you.
Thank you, Kay. I'd like to say hello to everybody attending this call. We realize it's quite short notice, but data are also kind of coming in. Yeah, I mean, China is surprising us with lots of interesting data, to put it nicely. We had PMI data, Caixin and official, all quite negative, especially services as we would have expected. But today, let me also say that we will publish a note today on that data and our forecast, revised forecast at 4.2%, taking already into account the big infra stimulus that we're expecting. So it would be lower otherwise. So we've estimated the reduction already due to mobility restrictions, the reduction in GDP growth to be around 1.5 percentage points for the months of March and April, just the impact of those 2 months. But we are not here to talk about China's GDP. It's just that I thought I should add that, given that we're getting that note out in a minute. Today, the topic really is capital flows into China, with particular attention to the bond market. So this is a report we publish regularly. We look at bond market data. The main author is Gary Ng, and he should be here any minute. And I'm going to cover the first part, which is basically the introductory part of the report, going through the macro data as to where we stand with the balance of payments, what we can read, because balance of payments data, unfortunately, many of you might be following this, is quite dated. So it's hard to read, the extent of outflows and what to expect. So the bond data allows us to do a little bit of that, and Gary will go through both onshore, offshore bond market data to draw conclusions on outflows, but also more generally on market expectations, what to expect from this market in the future. So the title basically says it all. So I'm going to spend a minute on the title. And it's really about outflows since March. It's not overall, it's not FDI, it's not, of course, trade. On the contrary, we had very good trade figures in March, simply because imports collapsed, growth rate was slightly negative. So China continues to accumulate net inflows, if I may say. That's not the point. But portfolio flows, i.e. equity, and especially bond, fixed income flows, have become negative. And we give 3 reasons for this. For bonds, the main reason is the Fed, the vanishing yield differential, which many reporters have already talked about. But I think there's more than that. There's more than vanishing yield differential. There's also Ukraine, and here it's very hard to see in the data how much is the differential, how much is Ukraine, how much is COVID. I guess as we see some buy in the dip on the equity market, I'll show you a graph in a minute. One could argue that a lot on the bond market is really yield differential plus expectation of further depreciation of the renminbi, meaning basically that expected positive return compared to an investment, say, in US dollar, has literally disappeared. That's the main reason. But I think as we move on, and I would love to have questions and comments from your side, the question really is, what's the role of sanctions? Is this also an issue? We got a list of another 80 companies today. I mean, is that something that is driving outflows as well? I think that's a big question. It's hard to respond to that question with the existing data, but um, I think that's one of the issues we'd like to explore. So without further ado, I'm going to show you a few graphs. I realize that sometimes we bore you with too many, but I'll use a few since they've been prepared. The first is, again, what I call like dated data, given what's happening in China in 2022. Any graph of 2021 is like, okay, I mean, everything has changed since. But I think it's important to note that in during COVID, so 2020 and especially 2021, China has been a magnet of capital, whether it's thanks to exports. So you see there the violet big chunk of the accumulation of forex receipts. I'm not using forex reserves because and some of you, I mean, I know that there is some journalists in the room have written about this. I think it's quite interesting. Where are the forex receipts in China? Some might not be in at safe anymore. I mean, it apparently banks are holding a lot of this now, and I think it has implications for the exchange rate. We could discuss that later, but the point is there is huge increase in forex receipts in China in 2021. And it's also direct investment, foreign direct investment. So the net investment becomes very positive in 2021. So hardly any outflows. China is no longer in that buying spree, but others are in a buying spree in China. And securities investment, which is the focus of the conversation today, that light blue, is also very positive. It's been positive since 2018. And if you have these numbers in mind, what it means in 2021, even bigger, is that China, foreign, or at least that they don't have to be foreigners. They need to be non-resident, to be specific. Non-resident investors by now hold 4% of China's bond market and nearly as much of China's equity market. So it's quite big. Not the, of course, not the US, not even Japan. Japan is over 9%, I believe. So, but it is big, given that before 2018 it was hardly, I mean, close to zero. So it's a big increase in foreign ownership in China's capital markets. Now that has changed, and that's what I want to show in the next graph in the overall data net FX receipts. So basically the net position of the balance of payments. So you can see there's been a massive drop from that positive and basically entry of dollars in China, which has all of a sudden only recently changed tune, so to slightly more positive. But of course, this alone explains the weakness of the renminbi. And although there was a little bit of a hype this morning after the Fed appreciation and then back, to me, as long as we continue to see outflows, portfolio outflows, it's going to be hard to see a strong renminbi. Of course, it also depends on trade and so on, but I think it is a very, very rapid move, what we're seeing here, and that is something that we should be watching. So I'm going to move now to basically the idea of the kind of this dual behavior. The current account in 2020 continues to be very positive. So I just mentioned, I think exports grew over 12% and then minus 0.1 for imports. So, you know, big room, basically because China is hardly importing. I mean, at least change in imports, thanks God, not the level. But because of that, even if you export less, you get a lot of cushion from the current account. And by the way, people aren't traveling anymore, which was a massive source of outflows of dollar, which we estimated in a past report right before COVID to be 1/3 of imports for China, so massive. And all of that is zero now, or close to zero. So the current account is a huge cushion, and I think that explains, the Chan, I think, not this Politburo, but right before that, saying we want to stabilize trade. I mean, trade is important in the current circumstances because, as you can see from the blue line here on the left, the financial account is collapsing, meaning outflows big time. They're close to 40 billion already. So I think that's what is driving this, holy war, if I may say, towards trade is needed, and perhaps nobody can prove it, but perhaps some control on imports, yeah, beyond quarantine rules and everything we hear. So sorry, it's a bit slow for me to move the slides for some reason. It's the take control that doesn't seem to, yeah. So now again, so in 2022, what is happening is not a little bit of direct investment, so it's not growing as fast as 2021. So foreign companies aren't just jumping in the Chinese market. Frankly speaking, given what we're seeing with COVID, it's kind of logical to see this stagnation, but it's not a collapse yet. At least we don't see that in the data. But securities investments, which could be equity or fixed income, is really the mover, over 40 billion. And again, kind of supported by a slightly positive FDI inflow. And now the next question I want to answer is out of the two major sources of portfolio inflows, which one is moving? Is behind this massive collapse in portfolio flows? And if the graph is shown, and if not, you need to believe me, since I've looked at this before this presentation. Is basically fixed income investment, and that's what is driving, especially lately. There is a lot of buying into the deep on the equity space. I think this is also because, as you probably remember, there was this kind of moment of truth before Liuhe's pitch, and where tech stocks lost about 70% and everybody was very negative. I think since then we've seen some recovery. There's this idea also after the Politburo that China will support internet companies, that the regulations won't be as strict. Of course, we've had a little bit of a hassle lately because of a confusion, so-called confusion, as you know, on the Alibaba space, and I don't want to get into that one, but the point is that that was only supposedly just a mistake or a misunderstanding, and that call for a more normal or stable stable environment for in the equity space. Here you go. Equity and bond. That's the graph I wanted to show you. It finally showed up, and you can see the recovery in the equity flows into China, while bonds aren't really. And I think that's quite important. So I just want to say that, of course, because we see this different behavior between equities and bonds, to me the most the most obvious explanation is that the yield differential, the vanishing yield differential, is a very important reason for outflows. In fact, when you look at the bulk of the outflows on the right, is basically treasury bonds, policy bonds. So it's not risky assets. Of course, risky assets are never very important in China. If you look at those graphs, if you look at, like negotiable certificates of deposit, which are issued by generally smaller banks, they were big once upon a time in 2021, so people were buying anything basically. Now they're small, but also negative. So, but the bulk of the negative is indeed kind of safe assets, and that's the yield. I mean, the yield differential story that I want to highlight. So this is it. You can see that it's not so much about China cutting or like reducing the yield. Is the US increasing the yield. So it's a kind of an asymmetric reason, if I may say, for the vanishing interest rate differential. It's about the US. It's not so much about China. In fact, China has been very careful, as you all know, to cut the LPR, and rightly so, because if it did cut even further, probably outflows will be bigger, and I think that's something that China doesn't want to see. Um, uh, the other thing is Ukraine, as I mentioned. How much is sanctions? Hard to tell. I think we can see some interesting move in the RMB cross-border interbank payment system, but basically, um, to really make a call that the renminbi is kind of being used, safe asset. People want to be invested in renminbi. People are jumping. We should see big inflows, yeah, on especially risk-free assets, which is not what we see, as I showed you in a minute. So, I mean, a minute ago, the graph where you see that policy banks and sovereign bonds are plummeted. So there is no such sense as the safe haven type story that we heard at the beginning of the Ukraine crisis. One reason might be sanctions, and again, it would be nice to hear. The other is COVID. The other reason for the outflows. And here, and this is, we actually have a summary graph. This is hard to read, I understand, but I think it's in. We have a summary graph looking at mobility, yeah, in China, and that's how we estimate the impact of COVID on the Chinese economy, which I mentioned so far, according to our estimates, based on this mobility, in the loss of mobility, is 1.5 percentage points. But why is this important for portfolio flows? Because as you can see, we're not yet back to um, February 2022. March was already quite much better. But I think, if you look at April 2022, it's actually worse than March 2020. So it's not peanuts. I mean, it's a big shock for the Chinese economy. And I'd say that by looking at the number of reds, which is basically cases where mobility is below, above, I mean, loss of mobility above 60. So that's how this is calculated, and that's quite something. We have already two major provinces and two other up there in April. So the other reason for the outflows is really growth expectations in China and what that might be. Yeah, and I think the combination of these three, the Fed, Ukraine, and COVID, are behind the outflows. I wonder what's going to happen with equity flows if they still kind of ad hoc news on companies and still the impression that that listings from the US in the US will have to be stopped. I mean, all of that might not dwell well on equity flows in the future. There's also some, and I'm going to finish with this one, the idea of the real estate sector. Maybe some flows were related to the real estate sector outflows. It seems unlikely because, again, most of the flows were on safe assets, outflows from China, fixed income. And I think the other reason is that what we've heard in 2022, I'm focusing on 2022 here, is quite positive. Yeah, I mean, nobody talks about three red lines. Actually, China planned. This is what we add here in the regulatory part of the report. Plan to relax the three red lines to encourage state-led property developers to acquire weaker developers, etc., etc. So I don't think the focus of what we are seeing is related to the real estate sector. If anything, it's thanks to the government's measures to support the sector that we're not seeing more, if you ask me. And I think that's where I would end, and I would leave the floor to Gary.
Sure. Hi, everyone. I hope you can all hear me. So I'm Gary Ng, senior economist at Natixis, working with Alicia, covering Asia Pacific thematic research. So today I'm going to discuss our observation and expectation on the China's bond market. As Alicia has mentioned, there has been quite a bit of outflows that we have seen. And the reason that we have this actually a quarterly report and this press conference is that what happens in China's bond market can have implications beyond the asset class itself and reflects the trend in the macroeconomy. So getting straight to the point, if 2021 was not really a calm year, as we have all experienced, 2022 may not be better, and it will still be a year with turbulence for investors in China-related assets. So last year, the market was worried about this liquidity condition, including the changing monetary stance, higher yield in some developers, as well as credit risk. And these concerns continue to be valid for investors this year, but for different reasons. And a key advantage of our approach is that, as you will see in a minute, is that most houses usually look at it from either only onshore and offshore perspective. But we are going to compare these two markets side by side to actually help us to actually see what are the similarities and differences in both markets so that we can see a concrete macroeconomic picture. So to begin with, if we look at the next slide, sorry, it should be the other way. 1 second.
Gary, can you get control back?
Actually, yeah, housing is helping me to control it.
If not, I can just move the slides for you. Up to
you.
you.
Sure. That would be great if you can.
Actually, it's very slow on my end, so this is just bear with me. It took me a while to move the slides on my end too. So
Sure. Yeah, sorry for the to the audience for the technical issue. Yeah, so I think I will still continue first. So to the primary question is really where the liquidity is heading. If we think about any any potential consequences, and what we have right now is that the onshore monetary condition is now laxer, and then if we manage to see the slides in a minute. So basically what we will see is that on the one hand, in the onshore market, even though we now have more money from the PBOC, and it's not like all the firms can actually get the money. It's really about state-owned enterprises and financial institutions that are the one who managed to get this net bond issuance, of which the slide has appeared and which is on your left-hand side. So the similarities between these entities is that of course, on the one hand, it is a reflection of the strong policy support driven by government-led investment. And on the other hand, it's also about this extra help given to banks to boost their capital ratio, and especially in a time that China wants these banks to actually lend more to the real economy. But but for the entities that manage to get the liquidity, The other side is that some people may not be able to get it. And the loser here is clearly private firms because they are crowded out with this very limited ability to expand, as you have seen in this blue bar in the onshore market, which is virtually zero. And in the offshore market, we even seen a reduction of net issuance. So this explains why we actually see that this risk sentiment has been rather high for these firms, and also from the business perspective of the sentiment for them has been poorer than the larger one for at least the past, I think, 12 to 18 months. And beyond the quantity, we will also see that the funding cost is also very important. As the monetary policies of China and the US is now out of sync, as Alicia has shown before in terms of the policy rate, the trend is also reflected in this onshore and offshore bond yield evolution. And especially if we look at the next slide in the offshore market, the turn of the monetary tide has largely resulted in an increase in yield, generally in line in different ownership or basically generally for different sectors. But it is not the same for the onshore market. The story is simply different. There is a clear increase in the bond yield in private and real estate firms. And if we put the two markets together, it is obvious that investors remain rather concerned on private firms, which is what this slide is showing. And in the next slide, we will also see quite a sharp increase in yield for real estate as well, which is you can see in the purple line. So this is really the bad news that we are seeing is that private and real estate. But if we look at the next slide, the good news is that if we look at the general market, the credit spread hasn't widened too much. It also shows that this concern on risk is mainly very, very concentrated into specific area in the Chinese market, especially if we consider the non-sovereign entities, which is within the corporate wealth. And of course, we have talked about the amount of liquidity. We have talked about the higher funding costs in some entities. The next question, putting all this together, is that what about the credit risk? And the way that we measure it is that we take a broad measure of bonds with repayment pressure, which include the usual actual bonds that many people may have looked at, but also expand the definition to technical default and extension. The reason is that the definition of default is often subject to debate, and different people may have like a different views on what should be considered as default. However, if we include everything, at least it will show that whether the number or like the value of bonds that actually under repayment pressure has increased or not. And before everything, the first point to know is that the overall default ratio, of course, has increased in past years and remain elevated, but it is actually still low comparing to global standard. And especially if we look at this latest trend on the left-hand side, you can see that the ratio of the onshore bond with repayment pressure has declined slightly in 2021. In 2022, last year it was 0.56%, and now as of March on a 12-month basis is 0.46%. So yes, we do see some improvement here, but the same doesn't really translate to the offshore market because the same ratio has increased from 6.4% to 6.8% for the same period. So that also means that even though there is an overall picture seems to be a bit better, at least from what we see from the onshore market, there are still two major concerns which we should look into. The first is that the repayment the firms with repayment pressure are still growing, especially for the private sector. And the second is that the real estate sector remains the most important sector with repayment pressure, and which we can see in the next slide, the orange bar. So these are all in lines with what we talk about in the first part is that private firms cannot get liquidity. And in the second part, that the yield increase mainly come from private and real estate firms. And all of this has put together into this picture that we see in the credit risk side. So what it means is that it will mean a general more credit polarization trend that we see within the entities that we mentioned. And we have also prepared two slides which we can dig a little bit deeper about how is this real estate sector performing, given that it is the majority of the risk. So obviously, yield are increasing, especially for private firms. And even though we have seen in the regulatory table before that there are indeed some marginal relaxation of regulations in the real estate sector, this changes is simply not strong and fast enough. And as we see, property sales still fail to pick up. And especially, of course, with property sales, you also need to see the ability to invest and also whether basically developers can acquire different land. And then we actually see that the real estate residential investment also remain weak. And even on the demand side, the mortgage loan growth are still decelerating, which is on the next slide, left-hand side. So on the market sentiment perspective, the share of firms with negative market sentiment has also climbed further from 35% in December 2021 to 38% in March 2022. So all of this together basically means that credit polarization has only become even stronger among different pairs, such as SOE versus POEs, real estate versus other sectors, and even within real estate developers itself, investors are only going to be more selective, especially given all the risks such as the Fed, Ukraine, and what we see in the zero COVID policy right now. So I would like to conclude our part with the conclusion slides that we have prepared. So a short take from what Alicia mentioned is that yes, we indeed see this sudden portfolio flows, especially from the bond market, which is kind of worrisome because these are usually considered as the safer assets that investor would want to invest in China. And the reason, of course, is the yield differential between the US and China, which is an obvious market-driven factor. But increasingly, there are also factors that are hard to measure, such as geopolitical risk, and also about this influences or this negative impact from COVID. And all of this lead to the next part that we have discussed about the performance in the bond market is that because of this uneven recovery or uneven allocation of liquidity, credit polarization has only increased in China. And this would mean that credit risk can also increase within a certain sector, especially in the real estate. And if we continue to see more lockdowns, the risk can actually spread to other areas in different supply chains, such as electronics and other sectors, as real estate is not really the one that has defaulted before, but also with potential in consumer sectors and also electronics, as we have seen in the past 2 years. And the question after this is really what's next and what will happen to the China's bond market in the future. So definitely, yield differential will continue to be the most important factor. China will try to lower rate further and inject more liquidity, even though recently the stance has been rather cautious, but it doesn't mean it will not come further. In the US, the Fed will only hike rate because of the inflationary pressure. So in the short run, because of this widened yield differential, definitely it will make Chinese bond a bit less attractive, especially if we continue to see capital outflows, which actually feel the depreciation pressure of the RMB. That basically means that it's quite likely that investor may lose in the short run if they try to invest in Chinese bonds, given this depreciation pressure in the RMB. However, in the medium run, China remain a market that is big, and then it is growing. And of course, it is also kind of underweighted in terms of a lot of investors' portfolio. So it will continue to be rather attractive. And the monetary tide has turned for the Fed this time. But of course, the tide will also turn in the future. And definitely, there will be a scenario that investing in Chinese bond will be attractive for investors. So with that, I will pass it to back to Alicia after concluding this part.
Great. Maybe we can put down the presentation to be able to see each other, and we would be very happy to receive feedback, questions from the floor. So who wants to
Hi,
start?
Alicia. Actually, we have 4 questions in the box
Okay,
already,
sure, in the
so
chat, maybe,
maybe we
yeah.
can start from there.
I
Yep.
was looking at the hands, but the questions are already there. So let me see. So questions from Debra Brata. Actually, 3 questions. So do you see any parallels between the renminbi sharp depreciation in? Oh yes, oh, I love this topic. The 2015. I'm actually writing an op-ed on this as we speak. So it's a good question. Is it a remake of 2015? It isn't, in my view, for a number of reasons. The situation is very, very different, and that was all about Decree 89, I think was the name. You know, like the basically the push to create an environment for Chinese companies to do IPOs, to deleverage by increasing equity, you know, and it was all like engineered, a little bit like financially engineered. We had the problem of excess capacity in China at the time, but in a way it was a totally different problem. Now, we could end up having a kind of a faux pas, as they say in French, of the PBOC, kind of making a mistake, which to me, the movement on the 8th of August 2015 was like suddenly, you know, 1.9 or 1.6, I can't remember the valuation, but I think the PBOC has learned from that case, and it's going to be different this time. The outflows then started because of China's move. They didn't start because of the Fed tightening. It's a very different ballgame. And, you know, China's outflows are not unheard of in the region. So we have a lot of outflows from Taiwan, actually 8 billion only in April, which is big for Taiwan, 8 billion in March. We have outflows from India. So it's more of a, like, going with the pack with Chinese characteristics. What are the Chinese characteristics? To me, COVID and the uncertainty of sanctions. So very different in essence, and I hope that answers the question. There's so many questions, so I'll be brief. I'm going to leave the floor to, maybe we take one each or something like that, Gary. Maybe you can take the second from the Babrata. What do you think the net capital flows will, when do you think they will bottom up and turn positive?
Also, I think there are 2 major factors here. One is, of course, from China, is that because of this regulatory crackdown, etc., there has been generally a negative sentiment, even driven by like from the internal perspective. Especially we have seen for equity. So the equity market seems to be still quite basically sensitive to a lot of this type of news. So, but still relatively to bond, because there are for equity at least the cross-border flow between whether at least if we look at the stock connect, whether foreign investors are actually going into the A shares to actually buy the dip, or they decide that they would want to reduce the shares in Hong Kong because of this like higher interest rate from the Fed, which actually negatively impact a lot of tech firms, such as if we can think of Tencent or Alibaba. So indeed, for the equity side, it has acted a little bit in favor for the onshore capital inflows because of this more allocation towards Asia's, and at the same time, a lot of mainland Chinese investors are retreating from some of this tech-heavy sector. But on the other hand, for the bond issue, it may be a little bit more long-lasting. The expectation on the Fed is not going to change overnight, and this yield divergence between China and the US is also more like lasting versus the equity story that we have seen. So my take is that for equity market is likely to see like a continuous inflow, even though it can be some turbulence and etc. We're talking about net inflows here, which also include Chinese investor retreating from Hong Kong. But for bond, it's really a global scenario that even for some Chinese investor, they may think that like the US bond may be more attractive, and let alone some foreign investors that are actually investing in Chinese bond. So that's why I think we see this divergence between this equity and bond performance and in terms of capital flow. And I think this is likely to continue. So so I think in the next few months for China, it's likely to see this hovering trend of maybe we can see 2 months of outflow and then 1 month of inflow that also may be boosted by equities. But in general, I think for security investment, it will not be too positive in terms of attracting this net inflows.
Thank you, Gary. Fully agree. And on that note, question 3, renminbi. Can weaker renminbi help China? Well, I mean, China is a massive export machine. It exports 1/3 of the world intermediate goods. So one could argue that, you know, if you're having difficulties with the domestic demand, cheaper currency may help. Remember that since 2020, we've seen appreciation of the renminbi. So it isn't necessarily yet very, very cheap. But the problem is that this type of round, some of the problems with exports are actually not related to pricing. In fact, we have some calculation at Natixis. Unfortunately, so far, not yet for the first quarter. I need to check if we can already do that or not, but of basically dividing exports into price increases and volume. And I think it's very interesting because a lot increasingly is price increases. So China has been using its kind of a markup because especially in 2021, Vietnam was closed, everybody was closed. So China could use this market power. So if you can use market power, depreciation is not necessary. You know, it's not. China might not have been, in my view, in a position to really need a depreciation. Whether it can help on the one hand slightly, but if your components imports components to then export are locked, for 7 days in quarantine, it's not that a 2% depreciation changes the picture. I mean, it's your problems are different now. And I think that's why my sense is that's just my sense, because the PBS is not making big statements on this. I don't think this is policy driven. I think it's market driven. It's markets deciding, you know what? I mean, maybe I'm going to enjoy a higher yield somewhere else. And because it's not policy driven, it's happening in a very different way. I would even argue that it's been that the depreciation has been smoothed out. I can't prove because the PBOC doesn't seem to be intervening. We don't see any loss in reserves, but my sense is that it's been ironed out. So I'm not on the camp that this is one policy option that the Chinese authorities or policymakers are using. I don't think, and you know, after 2015, you don't want to play around because you lost $1 trillion in reserves playing around. I just don't think that's what they're trying to achieve. Actually, the contrary. I think they want a stable renminbi in the current volatile environment. So on that note, I'm going to leave the floor to Gary. If you think, Gary, if you're fine with Amanda's question, just to follow the order.
Sure. I just want to add one point to the RMB is that I think
Sure.
the move that the PBOC or basically the Chinese authorities try to lower the FX requirement basically shows that on the one hand, as Leisha mentioned, China doesn't want to use its reserves directly, and on the other hand, there are actually other resources that China can actually use to stabilize the currency. So of course, it's kind of the official stance that repeated many times that we don't want too much appreciation, we don't want too much depreciation, and we just want stability. But of course, this range is likely to be a bit wider because of this global market change. But definitely, I don't think the policy. I also agree with that. I don't think the policy is like gearing towards basically a stronger or weaker RMB in the future. It's simply about smoothing this volatility. You don't want this to change too drastically that happen affect corporate. So for Amanda's question, definitely, if we talk about easing, on the one hand, there could be more money injecting, such as more local government issuance, bonds, and on the other hand, definitely because of these stricter regulations over years, I think it's likely that we will see some relaxation in terms of real estate and generally for local government investment, not only LGFV but also local government. And for Q1, we haven't really seen a strong increase in the bond issuance in LGFV. But on the other hand, local government, which is the bond, local government bond, which are the part that they issue directly, have increased massively. So I think this is the reason that we haven't really seen that LGFV picking up. But eventually, if more support is needed from the policy, definitely for real estate, I think more provinces will be allowed to kind of lower rates, which has already happened, or relax different down payment ratio based on their own needs. Even though if we look at the central government statement, housing is always not for speculation. That one is to stay, but there will be more flexibility in terms of this local regulation side. And for LG, FB and local government, I think at least from the local government bonds perspective, they will be allowed to use the money in a wider range. Last year, we already see that money can be used to help some of the local banks in terms of capital. And of course, there can be a wider usage in terms of what we call infrastructure investment, because we cannot only build roads, bridges, and etc. That could be expanding other sources. The same can be applied to LGFV, especially in terms of using those money like into like the core capital of projects and etc. So definitely these two are the important tools to kind of support the economy.
Thank you, Gary.
That's a question. Yeah, that's a question on Fed. I think you may be in better position to answer that.
Yes, maybe there's quite a few questions. One, I mean, we have like 3 or 4 questions. Well, I think what we can do, because we want to be on time, let's first hear the question. I think it's Tom raising his hand, and then we pack the questions. So, Tom, the floor is yours.
Thank you. I didn't mean to jump the queue. I wanted to ask if the foreigners are selling. Who do you think is buying in the bond market, and why? And do you think this portfolio flow dynamic is going to produce a policy response, and what might that be?
That's a good question. I'm going to add a little bit, but I want to, because that was the purpose of jumping the queue, is to see whether there was some, question that we could pack. I think there's a question on, well, let me see. I think one could be, well, there's 2 on the Fed we can pack, and then, and one way to answer your question could be to take this full convertibility of renminbi as, the one kind of extreme response. So first of all, I think we have a graph, Gary. I don't know whether it's in the report or we could share, but looking at non-residents versus residents flows, like we see that non-residents are selling. So there's 2 ways to look at these are gross numbers. So basically you can see whether non-residents are buying net or selling net, and then you can see whether residents are buying abroad. So generally the action is on non-residents, and there's a very simple reason for this, because they still quote us for residents to move out. So generally they don't lead the pack, certainly not on portfolio flows. because maybe we are at the top of the QDII quota, so you cannot increase it further. So the action tends to be on the non-residents, selling off basically their holdings, and this is what we see in the data. But then we also have, maybe Gary can add that, the Stock Connect data, so where you can see whether it's northbound, southbound, but I think it's quite similar. Not a major difference there. But to your question of what they could do, which I think is even more relevant. Well, first of all, we want to see net errors and omissions, which we don't have yet. I mean, we want to see whether there are unrecorded outflows from residents. We know there aren't many for recorded, because again, maybe it's at the top of the quota, so they can't. But what about unrecorded? And that's something that I think we need to wait a little for that data to come out. But maybe Gary wants to add, because that's very important information. If it's residents kind of packing, meaning finding other opportunities where to place their money in an unrecorded way, then we're closer to 2015. And if that's the case, I think the measures will be different, because for China to stop non-residents from selling, that's a big step. I don't think they will do that, because that means going back in their liberalization, like they've been saying, no QFII, quota, come, enjoy. Suddenly you put additional controls of any sort. I think that's going to be a killer. But if it's residents living unrecorded, you have all kinds of things, from 50,000 a year to 20,000 a year. I mean, I can think of those type of controls being imposed. So that's why it's essential to know who is taking the money out. Is it non-residents? So, somebody sitting in New York and with its portfolio, or maybe in Hong Kong, because Hong Kong, for this matter, still a non-resident. So I just wanted to add a little bit of color, that I think the measures, if they come, capital control wise, would be if residents are found to be taking money out. And in that regard, is full convertibility, I'm taking that question, if I may, a possibility? No. In my view, the answer is no, and no, and no, not now. We heard 2020, if you recall, many conferences in Hong Kong in 2012 on full convertibility by 2020. This was at the time, Governor Joe. It's not going to happen, because we are back to where we were. So my sense is no, but I mean, others may have a different view. We have 6 minutes and quite a few questions. Gary, can you do your best to take a few, and maybe you pick?
Sure. I'll just actually add something quick to the question that you just answered first. I think the reason about this, we can look at what the PBOC can control and what it cannot. Obviously, the PBOC cannot control the Fed, so the U.S. interest rate is only going to increase. And for the low interest rate in China, where we can lower it a bit slower, but definitely the yield differential will widen. But the only thing is really on the expectation on the RMB. So you can expand the trade surplus by reducing import, which is already happening, or basically allowing banks to convert more USD into USD into the RMB, or basically I think there are administrative measures that it can be basically put in place. So basically, if you ask about like who are buying in the Chinese bond market, we cannot forget commercial banks are the biggest holder of bonds in China. So definitely, I don't think they will run out of buyers. So in terms of the Fed quantitative tightening, I think the most important thing is that the world hasn't really encountered a situation of higher rates plus quantitative tightening before. Especially now, we also have this credit risk concern in China. So my take is that if we look at the credit spread in the offshore market, is likely to widen. And if we look even further into real estate plus private firms versus the others, probably will widen even further. So it is really a story of this credit polarization industry, and the when the liquidity actually is tightened, investor will become more picky and demand more premium in terms of holding the riskier credit. So I think this is what is basically going to happen. And this is also related to the question from Jay. I do think that it can be a concern about in terms of this higher rate. But on the other hand, we also have this weaker exchange rate, especially for a lot of real estate developers. Definitely the income stream will be in the RMB. So it is indeed a double whammy situation that they will face, not only about this weaker revenue, but also on the other hand is this weaker currency plus higher yield. So I think that definitely there will be like a higher, more concern in terms of this repayment ability, as this is what we have seen is that the default ratio, which is dominated by real estate developers in the offshore market, has increased a bit. So Alicia, I think there's also a question on foreign reserves. I think it may be your expertise.
Okay. Okay, so it's a kind of very open question, so let me answer in the following way. Forex reserves in China, I think we will not see a change in forex reserves anytime soon. I mean, the decrease, the reduction. First, because since 2015, forex reserves have become a big signal to the market. If you recall, everybody was watching, yeah, whether China was tricking with the forex reserves, whether everything was there, whether there was some. Everybody was watching because that was kind of the signal of the incoming crisis then, and China learned from that, and this means that intervention will happen differently. It also means that you know, everything will be cushioned before we see a big change. On the more general point you make on inflation, I don't know whether that was part of your, would that be a burden vis-a-vis the headwind of capital outflows, inflation? I don't know exactly what you mean by burden, but this is the way I read it. So when a central bank loses reserves, it's a shrinking the balance sheet. It's actually restrictive monetary policy. It's just that it's not the way the West does it because we don't have reserves. I mean, we have floating exchange rate regime, so nobody talks about this, but it's actually the case. So if you lose reserves, you need to actually create new liquidity. So, you know, basically domestic liquidity to counteract that impact. So so outflows are not inflationary, actually the opposite. That's what I'm trying to say here. But there are reasons to believe, including the financing of the infra-led stimulus that China is embarking on, that the PBOC will need to help. And let me tell you, we've already seen the transfer of profits. Very weird definition of profits. Nobody knows exactly where that amount comes from. But the point is that it has already happened this year. It's happening, yeah. I mean, they've already made one payment, the PBOC to the Ministry of Finance. So I'm expecting, and this is maybe unrelated, but to answer your question, I'm expecting easing, more quantitative easing coming from the PBOC in that regard. I mean, I wouldn't call it all the way. Maybe I said quantitative easing. This is a Freudian thing because we're not supposed to say that because it's not yet there. But I fear that that's the direction, and that will mean basically, you know, a different composition of the PBOC balance sheet as we continue to see outflows. That easing doesn't help because rates go down and there's more reasons for outflows. So you know, it's a challenge. Basically, the PBOC is in a challenging situation. 401, which means we need to stop here. But let me first thank everybody. If you have other questions, we can take them offline. So please send us an email. I think you all have the report and you can find our emails there. And I also want to tell you that after Gary's well-deserved holidays, I won't say where, but I'm very proud. we're going to come back to you with a different report, this time around on China's banking sector. It's a report we publish every year. So it's not a quarterly report, it's actually an annual report, and it has a lot of information on how the China's banking sector is doing. And I think in a way it adds a different angle to the China's easing and of course the outflows. How is that affecting banks, etc., etc. So this is kind of the first chapter of our conversation. We thank you all for being with us today, and thank you, Gary, for your contribution. Thank you all.